basis. Adhesion describes contracts that are written on a take it or leave it basis. And so when you start entering policy, when you start talking to clients, you close on the deal, you enter those policies in the system, and it goes to Transamerica or to Nationwide or to Pacific or to Global Atlantic, you know, or to Athena Annuities. They don't haggle with the terms of that contract. They write it and you either accept it or reject it. That's called an adhesive contract.
Adhesion.
Adhesive contract, contracts of adhesion on a take it or leave it basis. Aleatory just defines an unequal exchange of values. An unequal exchange of values. If we get a policy for you for $1 million, you're paying $600 a month, and they say that policy has long-term care. It has long-term care. And so you've had that policy for 4 months. On the 5th month, that person gets into an accident. That person gets to an accident and they can no longer walk, so they need long-term care. Say they were paying $600 times 5 is how much? $3,000. Would they be fully covered for $1 million for long-term care?
Yeah.
Yes, they will. And so that's why they call contracts aleatory insurance contracts, because there's an unequal exchange of values, unequal exchange of amounts. When you start paying, when there's a loss, the company, from their own consideration, is bound to cover it. Now, let me go back to consideration. You have to remember that consideration is not just the premiums we pay. Consideration is also part of the representations we make on the application. That is considered consideration. On the part of the insurance company, consideration is the promise to pay when there's a loss.
Yes.
And so when you start educating people about these instruments, one of the objections that you face in the field is that people will say, man, do these people really pay? I've gotten into this deal where they say, bring this money, bring that money. This person brings 5,000 and then we collect it and give it to this person. And I always say those are scams. This is for real. This is for real. Because it's in law that the insurance company contracts to pay when there's a loss. If there's a loss and they don't pay, what remedy do you have? You can sue them. And they'll pay you not just for the loss, but they'll pay you for emotional distress, for the stress, and they can pay you also for, they will pay you for your legal fees.
Pain and suffer.
Yeah. So these contracts are solid. So tell people, yep, they will pay, and they have been paid.
Okay.
So, so the promise by the insurance company to pay is also called consideration. So aleatory, unequal exchange of values. Conditional just defines the fact that, well, a contract can either be unilateral or conditional. Unilateral or conditional. Unilateral just means only one side makes a promise. Only one side makes a promise.
Makes the promise. Unilateral. Yes.
Only one side makes a promise. If you have a house and you have a lawn, and you see somebody who is going around mowing lawns, and you tell them, if you come and mow my lawn next week, I'll pay you $500. Or if you come and mow my lawn and cut my tree, I'll pay you $800. That's a contract. But it is a unilateral contract. Why? Because only one side has made a promise. Who made the promise?
The owner of the house.
The owner of the house. You made a promise. If you come and mow my lawn and cut my tree and drain my sewer, I'll pay you this amount of money. Did they make any promise to you?
No.
Nope. But if they show up on Tuesday and they mow your lawn, they cut your grass, they trim the tree, they drain your sewage, it's a contract binding now. Yes, it's binding. So So unilateral contracts are contracts where only one side makes a promise and the contract becomes bound through performance.
Okay.
Contract becomes bound through performance. What's conditional? Conditional is when both sides make a promise. Both sides. It's either called conditional or bilateral.
Certain conditions.
For the purpose of the exam, remember that an insurance contract is a bilateral contract.
Bilateral, okay.
It's a bilateral contract. Both sides make a promise. You make a promise to pay your premiums. They make a promise to pay when there's a loss. Yep. Explaining sources of insurability. Attending physician's report. It's the best or accurate information on the applicant's history. Again, when you start writing policies and start submitting them, when you submit a policy, the insurance company sometimes can make a decision in 24 hours. Because they can go into, if you look at the second point, MIB. MIB stands for Medical Information Bureau. And a lot of insurance companies will put information there. Sometimes you have reports on things that you've gone and they've done it with the doctor and all of that. When you submit a policy, the insurance companies have the right to go into the Medical Information Bureau and query all your medical information. That way they can make a decision in 24 hours. Or they can decide to seek for further information or medical information to clarify your status. In that case, they'll request from the doctor's office what they call an attending physician statement. Attending physician statement or attending physician's report. So sometimes you might have to wait or follow up with the doctor's offices to send that information. Because they know when there's a loss, they are going to pay. So they want to make sure that they are not handing over a policy to somebody who's going to die in 6 months. And if you die in 6 months and they had given you the policy, they'll pay. Or if you have a critical illness in 2 months, in 3 months, they will pay. Then credit reports, they say contain information related to a person's potential for loss, include consumer reports and investigative consumer reports. So, medical exam report conducted by physicians or paramedics. Sometimes they'll send people to your home to come poke your arm, take some blood, take your urine, measure your BP, your blood pressure, measure your weight, height, all of that to make sure that you're sound or that they know what policy and who they are giving that policy to. Okay, the next point, effective issue and delivery. I promise you 100% you'll see a question on this in the exam. 100%. About, and you might see more than one question.
That's true.
About when the policy becomes effective. When a policy becomes effective. You have to remember, that when you submit a policy or an application for a client with money going into that application, or your submitted application with payment of the premium at submission, there is what we call provisional coverage. So coverage is effective when there's submission of an application accompanied by payment. Coverage is effective.
Okay, wow.
However, as we know in life, there are always exceptions. Now, let's say you are 62, 64, and you submit that policy and the insurance company thinks that's the age where a lot of things start popping up. Health conditions, diabetes, high blood, you name it. We just want to make sure, though you're submitting this with payment, We just want to make sure that we know enough to bind ourselves to this contract. So we are going to, yes, accept your payment, but we are not going to issue you a provisional receipt for provisional coverage. We are going to issue you a conditional receipt. So remember that term, conditional receipt. Remember that when a conditional receipt is issued, coverage does not start until when that condition has been fulfilled. Remember that. But when that condition has been fulfilled, pay attention very closely. When that condition has been fulfilled, even if the underwriter has not approved the policy in the system, even if they have not delivered that policy, you are still covered.
Oh.
So remember, when they issue you a conditional receipt, the effective date of the policy is the date that that condition was fulfilled. And if something happens, if there's a loss between when that condition was fulfilled and when that policy was issued, they will cover. Because you had already paid a premium consideration and they gave a condition, that condition is fulfilled. So the policy becomes effective. All right. Last section here, they say, effective date of coverage, they say if the premium is not paid with the application, the agent must obtain the premium and a statement of continuous good health. You'll see questions that will say, if the premium was not paid and it's later approved and the agent goes to deliver the policy, what kind of documents should the agent obtain? One of those documents is a statement of continuous
good health.
Yeah. Statement of good health. Usually, when you submit a policy, there might be 4 documents that might be required for the client to sign. They will sign a policy delivery receipt, policy delivery receipt. They will sign a statement of good health. If there were any changes made, for example, if we applied for the policy and we submitted a request for preferred elite, and they decide to give you preferred or non-standard tobacco, then you also have to sign an amendment statement. An amendment statement showing that the client is aware that there was an amendment of the conditions under which the application was submitted. Amendment statement. So it's either a policy delivery receipt, statement of good health, amendment statement, or the 4th one is the numeric summary. Some people call it the illustration. Some people call it you will not see numeric summary on the exam.
Illustration.
Illustration. Yeah. The numeric summary or the illustration is just an illustration of how that policy is going to perform based on guaranteed and non-guaranteed values. But you will not see that in the exam. When you also start educating people about policies, let's say somebody had a term policy, and in your best judgment as a licensed financial professional, and you go, don't keep that term. It's not good for you. Get something that is permanent. So they agree, you're going to replace the term for a permanent policy. You have to ensure by all means necessary that the new policy is approved. The policy is cancelled. Because if you cancel the old policy when the new one has not been approved, and say that client had something pop up in their health situation and they can't get a new policy, then they are out of luck. That is called malpractice. Always approve a new policy before an old one is canceled. Since we are on that subject of approving a policy before the old one is canceled, Remember a term called twisting. T-W-I-S-T-I-N-G, twisting.
Twisting.
Twisting is when you use deception and unfair methods to convince a client to sign from an old policy to a new one. When you use deception, it's called twisting. It's an illegal practice. It's an illegal practice. All right. Enough of listening to me. Let's get into the quiz now. Enough of listening to me. Let's get into the quiz. Chapter quiz. Okay. I'm going to have people read. Vivian, can you read this one for us?
The font is too small.
All right.
Okay.
Yeah, it's better.
A little bit bigger now. Yes.
Yes.
Go ahead, Vivian. Let's read this one.
We say an applicant for a health insurance policy returns a completed application to her agent, along with a check for the first premium. She receives a conditional receipt 2 weeks later. Which of the following has the insurer done by this point? A, approve the application. B, both approved the application and issued the policy. C, issue the policy. D, neither approved the application and issued the policy.
Which one do we think is the answer? I think they've approved because there's a condition there, conditional. They gave a conditional receipt 2 weeks. That means the condition is met. The policy will not have been approved. Correct.
So
yeah, that's what I would pick, but I don't know.
So which one is the answer?
A, approved, is approved because said 2 weeks.
No,
Condition.
Vivian said they gave a condition.
give
No,
a condition.
they give a condition. What? Oh, conditional receipt.
They gave
Yeah,
a
2 weeks
receipt.
after that. And they gave the receipt 2 weeks after they received the application and the premium.
Correct.
So they've
Both approved the application and issued.
I said D.
I think it's D.
Neither approved the
Very
application.
true.
It's neither approved.
Yeah, they didn't issue it. Yeah, conditional.
Yes. Remember, and Vivian, you're right. Geraldine, you're very right. Remember, they applied for the policy, they submitted payment, but then the company sent them a conditional receipt, which means there was a condition that needed to be fulfilled. Neither approved the policy nor issued the policy.
Issued the policy.
Yes. And that is true. Vivian, you want to read that explanation?
Okay, it says when the agent received the application and issues a conditional receipt, the insurer has not yet approved the application and issued the policy.
Yes.
All right, let's take a look at this one. Geraldine, can you read this one for us?
An insured is upset that her new health insurance policy was delivered to her by certified mail and not through her agent. Which of the following is true? A, there is nothing wrong with this form of policy delivery.
Of course.
B, the insured should ask for a new policy to be delivered.
No.
C, the insured should complain to the insurer. D, the policy will not be legal until it's delivered by an agent.
Okay.
A is the answer.
A is the answer.
All right, we are pretty unanimous in that.
Yes.
What is wrong?
Okay. Means of delivery. Very true. Means of delivery. All right. Let's go to the next one. Desmond, you want to read this one for us? Desmond, are you there? You're on mute if you're reading. If Desmond is not there, Olua, can you read this one?
Okay. Under the privacy rule of IPA, protected information includes all individual identifiable health information. A, transmitted electronically only, held in a computer format, held or transmitted in paper form, held or transmitted in any form.
Okay. D is the answer.
D.
Right. And that's correct. Held or transmitted in any form. That's very correct. Desmond, you want to read the explanation below? I mean, Olua, you want to read that explanation?
Just a second. Okay, sorry. Yeah. Under the privacy rule of IPAB, protected information includes all individually identifiable health information held or transmitted by a covered entity or its business associate in any form or media, whether electronic, paper, or oral. This is called protected health information, PHI. Yeah.
Very true. Very true. Let's go to the next one. Okay. Miss Florence, can you read this one?
Who must pay for the cost of a medical examination required in a process of underwriting? A, applicant. B, insurer. C, Department of Insurance. D, underwriter.
B.
Insurer.
B, insurer.
It's insurer.
Okay. Over the next month or next 6 weeks, I want to see messages on the forum. This person has passed their exam. That person has passed their exam. Congratulations to this person, because you guys are just acing all of this, you know?
Yes, so
your understanding is top form. So, okay. And someday I'll be saying Miss Tina will be teaching this class.
yeah,
Log
I
in.
know.
Miss Vivian will be teaching this class. Log in.
Amen.
You know?
Amen. I
Amen.
said amen.
So, yeah.
I said amen to it.
All right. Let's Miss Karen, are you there? If you're there, you want to read this one? Miss Karen, are you there?
I think my volume is back up now.
All right.
I was muted.
You can go ahead and read this one.
Which is true? Which is true regarding obtaining underwriting sources? A, it is illegal to obtain information from outside sources in order to determine an applicant's insurability. B, the insurer does not need to inform the applicant of how the information is gathered, informing only of the source is sufficient. C, the applicant must be informed of the source contacted and how the information is being gathered. D, the insurer only needs to inform the applicant of how the information is being gathered. It is not necessary to disclose the sources.
Okay.
I'll say C.
Yeah, C.
No.
Which is regarding obtaining, which is what?
I'll say D.
I didn't see the question well.
The insurer does not need to inform the applicant of the information gathered. Informing only of the source is sufficient.
Okay.
I'll say C.
Let's go with C and C.
Yeah, C is the answer. But you can tell them the source if there is doubt.
Oh, that is tricky.
Which one is it?
The insurer only needs to inform the applicant of how the information is.
Applicant must be informed.
I think
The insurer only needs to inform the applicant of how the information is being. So where is the answer now?
Oh, I think
it's between B and C.
B and C. It's between B and C. The insurer does not need to inform the applicant of how the information is gathered. If informing the applicant, only of the sort, like this, for instance, they will say they got it from your credit report, or they are through Vision, or through Equifax, or through all that. I think that's what it means. The source where they got it from Equifax or through Vision, all that.
All right. So,
okay, let's see.
Miss Geraldine, you seem to have gotten it right.
Informed.
Yeah, I got this.
Yes, you seem to have.
Uncle Valentine, I remember this because you told me that when you apply for an insurance, because you remember I picked beep at some point, you told me that when you apply, they will send a consent form for you. Maybe if you didn't read
disclosure authorization form.
Yes, exactly. You sign it and you go through it. It tells you that they have the right to tell you where they got it from and how they got it. You have the right to know that.
Correct. So we've learned. So it's not just where they got it from, but how they got it.
How you got it, yeah.
How they got it. Desmond, can you read the explanation below?
It is required by law that an insurer informs the applicant of all sources that will be contacted in determining the applicant's insurability, in addition to how the information will be gathered.
Very true.
So it's C.
Very true. All right. 6 of 15. GSAP, if you are there, can you read this one? All right. Vivian, if GSAP is not there, can you read this?
Okay, it says, whose responsibility is it to determine if all the questions on an application has been answered? A, the agent. B, the applicant. C, the insurer. D, the beneficiary. It's A, the agent.
The agent.
Okay. Let's go with that. And that's correct. Remember, it's the agent. Sometimes we might be confused that it might be the insurer, but we are seen as field underwriters. So, and we are seen as representing the insurer. Remember that also. We are licensed professionals appointed
the principal
to represent the insurer, not the client. So, all right. Florence, can you go ahead and help us read this one?
The insurance policy, together with the policy applications and any added riders form what is known as A, a certificate of coverage, B, a contract of adhesion, C, blanket policy, D, entire contract.
Is D.
D, the entire contract.
All right.
The policy application, entire contract, D.
All right. Excellent. Florence, you want to read the explanation below?
When the policy is issued, a copy of the applications, any riders and amendments are attached to the back of the policy and become part of the entire contract.
Correct. You will see this question in the exam, 100%.
It comes
Yes.
all the time.
Yeah, 100%. All right. 8 of 15. Vivian, can you read this one?
Okay. An agent is ready to deliver a policy to an applicant, but has not yet received payment. Upon delivery, the agent collects the applicant's premium check, answers any questions the applicant may have, and then leave. What did he forget to do? A, offer her a secondary policy. B, ask the applicant to sign a statement that acknowledges that the policy has been delivered. C, ask her to sign a statement of good health. D, collect delayed payments. The answer is C. C, because an agent deliver have to get a statement of good health.
Correct. Very true. Very true. I'm so happy with this class because all what I have to be doing mostly is just clicking. Just clicking.
Statement of good
Vivian, you want to read that explanation?
Says if the premium is not collected until the policy is delivered, the agent must receive a statement of good health, which acknowledges that the insured health status has not changed since the policy was approved.
Correct. 9 of 15. Olua, you want to read this one?
Okay. In a replacement situation, all of the following must be considered except A, assets, B, limitations, C, benefits, D, exclusions.
Say A.
Okay.
Yes.
Geraldine says A.
Mm-hmm.
So remember, when a replacement is occurring, we have to be conscious about the limitations of the new policy. We have to be concerned about the benefits of the new policy. We have to be concerned about the exclusions of coverage of the new policy. What has nothing to do with replacement is assets.
Yes.
Correct. Olua, you want to read that explanation below?
Okay. In a replacement situation, the agent must be careful to compare the benefits, limitations, and exclusions found in the current and the proposed replacement policy.
Okay. Miss Tina, you want to read this one for us?
Okay. On a health insurance application, a signature is required from all of the following individuals except the agent, the proposed insured, the spouse of the policy owner, the policy owner. Answer is C.
D.
The answer is C.
C.
The spouse.
C, that's what I said.
Correct.
Yeah, you got it.
Correct. And that's true. Tina, you want to read the explanation?
Every health insurance application requires the signature of the proposed insured, the policy owner, if different from the insured, and the agent who solicits the insurance.
Okay. Excellent. Question 11 of 15. Miss Florence, you want to read this one?
What phase begins after a new policy is delivered? A, pre-look period, B, elimination period, C, grace period, D, insurability period. The answer is A.
A, pre-look.
Yeah, pre-look.
Okay. Okay. This one needs no explanation. Let's go to 12. Miss Lola, welcome to class. I know you've been here a while ago, Can you go ahead and read this one?
Good evening, sir. Good evening, everyone. I will try as much as possible. I'm using my phone, so it's a bit small.
Okay.
An agent is in the process of replacing the insured's current health insurance policy with a new one. Which of the following would be a proper action? A. There should be at least a 10-day gap between the policies. Policies must overlap to cover pre-existing conditions. The old policy must be cancelled before the new one can be issued. D. The old policy should stay in force until the new policy is issued. I think the answer is D.
D, right?
D.
D.
Okay. Makes all the sense in the world. And that's correct. Next. Ms. Geraldine, you want to read this one?
Sure. Which of the following is true about the requirements regarding HIV exams? A. HIV exams may not be used as a base of underwriting. B. The applicant must give prior informed written consent. C. Results may be disclosed to the agent and the underwriter. D. Prior informed oral consent is required for the applicant. The answer is B.
B.
Okay. Written informed consent from the applicant.
Yes.
All right. Okay. You want to read that explanation, Ms. Geraldine?
Yes. A separate written consent form must be obtained prior to an HIV exam. HIV exams results may be disclosed to underwriters, but not agents.
Okay. Yeah, there are times you would submit a policy and they would decline the policy, and you ask for why they declined it. They will just say for health reasons. They will not tell you why. That's because the information that is contained there will probably violate HIPAA.
Wow.
Yeah. But they will send a note, they will send a written letter to the client telling the client why they declined the policy. Okay. Olua, you want to read this one?
Okay. What is the best way to change an application? A. Draw a line through the incorrect answer and insert the correct one. Start over with a fresh application. Erase the previous answer and replace it with the new answer. Leave the original answer and have the new answer with the agent's initials.
It's B.
B.
Over.
Right.
The first application.
Okay. What you have to remember also is that sometimes this option will not be there.
Yeah.
But they'll have the option where they say erase the previous answer, replace the new one, and have the client initial. Remember, it must have the client initial in it. All right.
Most companies require.
Yes.
Oh, sorry.
It's gone.
Yeah.
Okay. Yeah. Let's have Ms. Florence read this last one for this chapter.
What is the term used for an applicant written request to an insurer for the company to issue a contract based on the information provided? A. Application. B. Policy request. C. Request of insurance. D. Insurance request form. Application.
It's application.
Application. Yeah.
Application form is the request. It's called offer.
All right. So no need for an explanation there. Let's submit 93%.
So tell one, yeah.
So again, you guys are doing good work. Let's just reiterate this one, which is true regarding obtaining underwriting sources, and the answer here was 3. The information must be informed. The applicant must be informed of the sources contacted and how
the information was
gathered. Let's remember that. So, all right. So we get here to the next chapter, chapter 6, types of health insurance policies. Types of health insurance policies. Now this one is no picnic. This chapter is no cakewalk in the park.
I know.
But I would advise that each and every one of you go and read at least the chapter recap after this, because we are going to just highlight some basic things about this. So let me see what we have here. Okay, we're just going to go over some issues, and then we go do the practice test. So basic hospital coverage, again, covers hospital room, board, and miscellaneous expenses such as lab and x-ray. Let's remember that. Again, basic hospital, we're talking about room, board, and miscellaneous expenses such as lab and x-ray and medicines, while the insured is confined in the hospital. Again, basic medical expense coverage. If you have a policy that has basic medical expense coverage, it provides coverage for non-surgical physician service. Every time you see the word basic, it does not really involve surgical coverage. Okay. Then there's basic surgical expense coverage, which covers the cost of surgeon services, whether surgery is performed in or out of the hospital. So when they say basic surgical, it involves surgery. Measure medical policies. Measure medical policies, they involve comprehensive coverage for hospital expenses, catastrophic medical expense protection, benefits for prolonged injury or illness. Measure medical policies. Comprehensive, catastrophic, and coverage for prolonged illness or injury. 2 types of measure medical. Did somebody have a question?
No.
All right. 2 types of measure medical policies: supplemental measure medical policies and comprehensive. Supplemental or comprehensive. Just remember that comprehensive is going to be more encompassing than supplemental.
Okay.
It's going to cover more things. Health maintenance organizations, HMOs, preventive care, limited service area, limited choice of providers, co-payments, prepaid basis, primary care physician serves as a gatekeeper, referral, physicians, PCPs, referral are required. Just remember that for HMOs, the primary care doctor is the gatekeeper. And he's seen as the gatekeeper because he controls cost. You cannot just sit from your house, have a back pain, and then call and book an appointment with a back surgeon or a specialist in back pain. You first have to go to a primary care doctor who makes a decision if that is something that you are supposed to go see a specialist for. So they are seen as gatekeepers.
Gatekeeper.
So again, remember there are payments. The choice of providers is limited. The service area for the HMO is always limited.
Geographical.
But if you're out of the service area and you get into an emergency situation, you can see a doctor there. Preferred provider organizations, PPOs, a group of physicians and hospitals that contract to provide medical care services at a reduced fee. So PPOs will already have cost for certain specific type of services outlined. So if you go see a surgeon for, for allergies, there's a fee for it. If you have a fracture, there's a fee for it. If you are doing a yearly physical, there's already a pre-stated fee for it. So members can use any physician they choose, but are encouraged to use approved physicians who have previously agreed upon fees. Point of service plans, POS, they call them POS, point of service plans. They're a combination of HMOs and PPO plans. Employers are not locked in any one plan, allowed to choose depending on the need for medical services. So remember, point of service plans combine both PPO and HMO. Flexible spending account. These are accounts that they deduct money from your paycheck. They put into a certain account. You have to elect for them to do that. You have to choose for them to do that. They remove money, put it in this account, and they remove that money pre-tax. They remove that money pre-tax. The IRS gives you the right to remove, to dedicate that you're going to be removing a certain total amount for that year to cover for medical expenses. And they remove that money, they put it in an account. When you start using that money, then you submit your receipts to your HR department and they'll reimburse you. Remember, it's use it or lose it.
Mr. Valentine, can I ask a question?
Go ahead.
Points of service, is it not related to prepaid? Is it related to prepaid medical care?
No, not just prepaid. It combines both PPOs and HMOs. So these are specific plans that give you more flexibility because it has both PPOs and HMOs. You know, I remember when my kids were growing up, I used these flexible spending accounts a lot.
I'm asking about points of service, not flexible spending. It's understand. Yes, point of service plan.
Now, point of service plans, you remember PPOs, they already contract. They have itemized charges for certain visits. For HMOs, there are certain limitations. There are certain limitations.
Don't be testing it.
If you combine the features of the HMO and the PPO.
Who is talking there? That will not. I'm not hearing you, Dr. Valentine.
Yes, there's somebody who was. Let me see who is speaking. Okay, the person might have muted themselves. So if you look at point of service, there are a combination of HMOs and PPOs. So if you look at all of these features of HMOs and you combine them with the features of the PPOs, then you get the point of service plans. So they
when we get a question that relates to prepaid, specifically on what, and this
then you're really looking at HMOs.
Okay. All right.
Prepaid basis.
Yes.
You're looking
That's
at
what I'm trying to find out. Okay. Thank you.
Yep. So okay. So flexible spending accounts, again, if you have little kids or you have kids who have kids, encourage them to use the FSA accounts. they will help reduce their taxes because you deduct money from your paycheck, put it in these accounts, and then you can use it. Only remember, don't elect more than what you think you'll use, because if you don't use it, you lose it. You cannot carry it forward to the next year. You can even use this for daycare expenses for your child, the flexible spending accounts. So it's huge. If you think you're going to be using $10,000 for daycare for that year, elect for them to take $10,000 off your paycheck. They'll take it, put it in that account, and you don't even have to submit official receipts. You can write your own receipts. Just have a nice Word doc, put the receipts, this many hours of daycare times, how much per hour, put it there, sign it, send it to the company, they'll reimburse you. Then they are high deductible.
Sorry, Valentine, who's going to reimburse you? Is it the insurance company?
No. Okay, remember, when you work for a company, you're actually working with your HR department.
Yeah.
It's your HR department that works with the insurance company. So for FSA accounts, you send it to your HR department. There's a specific division in your HR department that deals with this. You send it to them, they reimburse you. Because remember, it's not they are not deducting that money and sending it to the insurance company. They are keeping it with your HR department with the company.
Okay.
And Uncle Valentine, if I may add, a lot of companies this nowadays, they give you like a card that almost looks like a credit card that is already preloaded. You know, it's loaded as every 3 months as the year goes by, the year goes through. So you actually have a card, your FSA account that has the amount of the money in it.
That's true.
Yep. Very true. Very true. This is good knowledge that can help a lot of families. Yeah. High deductible health plans, HDHPs, and health service accounts, HSAs. I usually see questions more about HSAs.
Yeah.
Yes. You mostly see questions in the exam about HSAs. Just remember that an HSA is like an FSA, but it's specifically for health. Specifically for health. And I think for HSA, you can carry it forward. Yes. You can carry it forward to the next year. Disability income. So this disability income is very big in the exam. It's very big. So replaces lost income in the event of disability. I don't know if we're going to see questions about, let me see. Okay, we're going to see questions about accidental death or explanations. So you have presumptive disability, specifies conditions that qualify insured for full disability. You have recurrent disability, specifies period of time during which the recurrence of an illness will be considered a continuation of a prior disability. So you just have these technicalities. If you have one disability, you have to wait for this long before you can come apply for coverage under that disability again. That's recurrent disability. Elimination period. Elimination period and probationary period are big. So pay very close attention. So elimination period, waiting period that lasts from the onset of a disability until the benefit payments start. So remember, elimination period, onset of a disability,
so
you have to wait for so long before the payments start. So let's say elimination period just means if you had a disability that lasted for 6 months and you had an elimination period of 2 months, you're only going to pay it for 4 months. And that is usually seen that way because companies usually have what we call short-term disability, right? The company will already be paying you short-term disability. So that elimination period is put in there so that you can use your company's short-term disability, and when that exhausts, then your disability income, which you're insured for, kicks in.
Okay.
Yes. So probationary period, there's a period after the policy starts during which benefits won't be paid. So remember, elimination period is when the incident, when the disability happens. Probationary period, probationary period is when the policy starts. So when the policy starts, there's going to be a probationary period. But when there's a disability, after that probationary period, then is fully covered. A way that I used to remember this is P and P. P and P. Probationary and policy. Probationary has to do with policy. Just remember, if they are asking a question on probationary, just think P and P. Probationary is about the policy. When the policy starts, you have a probationary period. And if it's not P and P, so if we're not talking about probationary, then we're talking about elimination period. And elimination period is the incident. So just remember that P and P. Benefit period, length of time, monthly disability benefit payments last. Benefit limitations, maximum benefits an insurer is willing to accept for an individual risk based on percentage of insured pass.
As lending.
So remember, they will ask you a lot of questions in the exam on what basis is the benefit calculated. On what basis is the benefit calculated? They'll ask you that in the exam. Remember, it's based on the insured past earnings.
Income, yeah, income.
Insured past earnings. Yeah. It's a Social Security supplement, SIS or Social Security riders. Supplement or replace benefits payable under Social Security disability. So Social Security supplement.
So how does that work?
Remember, it's not everybody that can collect disability under Social Security.
Social insurance.
Not everybody that can collect disability. What do you need to collect disability under Social Security?
You have to have worked for them.
At least 10 years.
10 years.
40 quarters.
40 quarters.
And you must be fully insured under Social Security to collect Social Security disability. So if you have a Social Security insurance supplement, then you can be paid Social Security disability under that rider. Business overhead expense policy. So reimburses small businesses for overhead expenses incurred while the business owner is totally disabled. Remember, the owner's income is not considered overhead expenses. The owner's income is not considered overhead expenses. Yes. Overhead expenses are things like rent, electricity, water bill, overhead expenses.
Yes.
Next one, business disability buyout policy. This is usually taken on partners of a business. So like if 5 partners join together to form a business, their skills, their individual skills are going to be very essential in running that business. So what happens if somebody who has a very essential skill, if they become disabled? What happens? Well, the disability payments can kick in and they'll use that money to buy out that agent. So that the business can continue.
So will it be a lot of money?
Well, good question. The answer is, as a lawyer, Vivian, it depends.
Okay.
So if you want a bigger disability, guess what? You pay a bigger premium as well.
Premium.
Okay.
It depends on your premium. Yeah. So key person disability, Key person disability is when is a provision that the IRS allows the business to identify somebody in the company that is a key person and insure that person. Remember, key person disability is very similar to key person insurance.
Mm-hmm.
The company is the owner,
Mm-hmm.
the employee is the insured,
And the company is the beneficiary.
the employee is the insured, and the employer is the beneficiary. Payments towards the key person disability insurance, remember, are not tax deductible. Payments towards key person disability or key person insurance are not tax deductible. How about the benefits when they pay the benefits to the company?
They are not taxed.
Are they taxed?
No, they are not taxed.
No, they are not taxed. They are not taxed. All right. Accidental death and dismemberment. It's only pays for accidental losses. So if your loss is not through an accident, they will not pay. It's considered a form of accident insurance. Remember, they will ask you questions about principal sum and capital sum. Principal sum and capital sum.
Yes.
Principal sum is the total amount that they can pay you for accidental death and dismemberment if there's a death. Remember, principal sum is bigger and occurs when there's a death. Capital sum is used when there is a dismemberment or an injury or a disability. For example, if you get an accident, and if you have accidental death and dismemberment, you have an accident and your leg is chopped off and you can no longer go to work, they pay you a capital sum, which is a percentage of the principal sum. You'll see this in the exam, capital sum and principal sum. Long-term care is available as individual, group, or as riders to life insurance policies. Long-term care pays you a certain amount if you have a chronic illness condition and you need long-term care. What is chronic illness? Chronic illness is when you're unable to perform 2 of the 6 active daily living activities. Chronic illness is when you're unable to perform 2 of the 6 active daily living activities. What are these active daily living activities? Walking, bathing,
eating,
transferring yourself, continence, and there's one other.
Yeah.
So those are all the 6 active daily living activities which qualify you. You cannot do only 2 of those 6, or you cannot do them without substantial assistance. You're chronically sick. They must provide at least 12 months of conservative coverage in a setting other than an acute care unit, guaranteed renewable. Pay attention to that point.
Yeah, 12 months.
Months of consecutive coverage in setting other than an acute care unit of the hospital.
Remember, it's guaranteed renewable long-term care, which means if you have long-term care, they have to renew it. The insurance company can increase the premiums.
Yes.
But it is guaranteed renewable. Pay attention to these other ones here. Very important.
Skilled care.
Skilled care, daily nursing and rehabilitation care provided by medical personnel. These are medical personnel like a nurse practitioner, they provide you skilled care. Intermediate care, occasional nursing or rehabilitative care provided for stable conditions that require daily medical assistance on a less frequent basis than skilled care. Custodial care, care of a person's activities of daily living provided in an institutional setting or in a person's home. That's custodial care.
Or like a person's solely. So person's home is custodial care.
Correct.
Okay.
Or in an institutional setting.
So like what? So institutional setting like assisted living places.
Yes.
Or prison.
Assisted living. I will leave it with assisted living facilities.
And the client's home too.
Home health care provided by registered nurses, licensed practical nurses, licensed vocational nurses, or community-based organizations like hospice in one's home. Home convalescent care provided by a long-term care facility, a home health care agency, or a hospital in the insured's home under a planned program established by the attending physician. Remember, home convalescent care has to be established by an attending physician.
Okay. Are we calling it? Will you call it like a place like
Nursing home?
No, I don't think not nursing home.
Group
Where you
home.
go for short time to
Oh.
get well. What is that name of
Correct.
the place?
Correct. Planned program established by the attending physician. Rehabilitative facilities.
Yeah, that's what I wanted to say.
Rehab.
Correct.
Okay.
Rehabilitative facilities. Residential care provided while the insured resides in a retired community. Residential care. Adult daycare provides for functionally impaired adults on less than a 24-hour basis. It can involve you taking your older parent and dropping them at an adult daycare facility.
Yeah.
Adult daycare. Respite care. Respite care is when you go provide relief to a former caregiver. You go provide relief. Say if there's somebody giving care to a family or to somebody who is needing care, and you go relieve that person, is that kind of care. It's called respite care. Group insurance. Remember, group insurance is you being provided insurance by the company, but the main reason for creating that company or creating that group cannot be solely for the purpose of obtaining income. Yeah. Underwriting. For group insurance, every member of the group must be covered. Next issue varies, cost varies between ratio of males to females.
Yeah.
So the more females you have in the group greater than the males, the cost is down. The more males you have, the cost is up.
Why?
Because men pie sooner than women.
Pie, that's pie what? They're not laughing.
Sorry, I just like that word, pie.
I know, that's okay. The word that I've been hearing it from Nigerians. I think it was their word.
Yeah, it's from Nigerians that I
Yeah, I heard them talking about it. I say, is it Yoruba or Igbo or Hausa?
Because I think social media does not allow them to use the word, other word frequently.
Yes, so they put it by,
Like you buy somebody, they don't want to use the other word. People that use the other word, they ban them from using it.
I just think the word is funny. That's why I use it.
I know it's funny when they say it. I'm like, I try to say, which language is this?
Yes.
What pie?
So qualifying events, voluntary termination of employment, COBRA. Qualifying events of COBRA, voluntary termination or termination of employment for reasons other than gross misconduct, e.g. company downsizing. employment status change from full-time to part-time, all of this you qualify for COBRA.
For COBRA, yeah. Length of
Limited benefit plans, accident, coverage for disability, those are all limited benefit plans. Dread disease. So it's coverage that covers you for specific diseases, such as cancer, heart disease, all of that.
stroke.
Critical illness pays a lump sum to the insured person upon diagnosis and survival of a critical illness. Usually, critical illness benefits will really kick in. For example, let's take, for example, cancer, when it's very serious, stage 3 or stage 4. That's when you get a full handsome payment for critical illness.
Oh my goodness.
Yeah. It's employer-sponsored plan, employer-provided group coverage. Sometimes employers will allow you to meet a certain requirement to cover or to qualify for the employer-sponsored plan. They might say, you have to be working at least 32 hours a week.
Mm-hmm.
Yeah, I have to be a full-time worker, minimum of 30 hours.
Correct. Types of plans, hospital indemnity. Remember, for hospital indemnity, they cover you on a daily amount or on a weekly or monthly basis while the insured is confined. So they cover you for a basic amount. So if the hospital charges less, they still pay that basic amount. The hospital charges more, they still pay you that basic amount. Dental plans covers treatment for care, prevention, and injury to the insured teeth. Remember, dental plans, they don't cover elective dental services.
Yeah.
Elective services are just what you choose to do. For example, if you go have some, you want to go have some fancy crowns or gold teeth or any of that, they don't cover it. Short-term medical coverage of people in transition. Vision hearing plans, a type of group insurance that covers eye examinations and eyeglasses or hearing aids on a limited basis. So this chapter on types of health policies, very important.
Yes.
Very important.
When I do my practice, this is where I really have problem. I always, not that I fail it, but I don't get all the questions correct. And I get angry with myself.
Yeah, me too. That chapter, I don't do very well on it.
Don't get angry, just get even.
Okay. Get even. That's okay. Get glad.
That is correct.
Come back and conquer it.
Yes, I'll conquer it. That's right.
Don't get angry, just get even.
Get even. Evil.
All right. So let's make sure that this does not challenge Vivian again.
Okay, even myself, it challenges me sometimes.
Vivian, can you start by reading this question here?
Okay. In long-term care LTC policies, as the benefit period lengthens, the premium does what? That is A, LTC premium are based on benefit periods.
Okay.
B, decreases. C, increases. D, remains unchanged.
Okay. Benefit period lengthens, that means they are going to be paying more. So what do we increase the premium to do?
The premium
renew
will increase then.
Correct.
It will increase.
That's correct. Vivian, can you read that explanation?
So LTC policies defines the benefit periods for how long coverage applies. After the elimination period, the longer the benefit period, the higher the premium will be.
Yes, it makes sense.
They could also ask you this question by saying, The greater the elimination period, what happens to the premium? It will decrease.
Trees.
Yeah.
The shorter
Yes.
the elimination period, what happens to the premium?
It
will
will have
increase.
increases.
Yeah.
I think I saw it in one of the one I was practicing today.
Correct. Desmond, are you there? Mr. Desmond. Let me see who is still in class. I see Desmond there.
Mr. Valentine, you said the greater the elimination period, the premium, is it increases or decreases?
Higher elimination period, the premium decreases.
Decreases.
Because it will take the company a longer time to pay.
Okay.
Sorry, I'm not feeling good. Go ahead. Let somebody else read.
Okay.
Okay, 1 minute to read. Okay.
Let me have Tina read this one. Sorry, Desmond, to see that you hear that you're not feeling well.
Hospital indemnity, hospital confinement indemnity policy will provide the payment basis based on the number of days of confined in the hospital, the premiums paid policy, C, the type of lines, D, the medical expense. A is the answer. The number of days confined in the hospital.
Correct. Because remember, indemnity, there's a specific payment they pay you for each day.
Yes.
Ms. Valentine, in about 5 minutes, I'll be leaving. Oh.
That's okay. We appreciate you being
But
here.
I'm leaving now. Actually, I'm even.
Okay.
Okay.
Bye.
Thank you.
All right. Thank you for having been here.
Thank you. I would have loved to be here for this particular question of long-time care, but unfortunately, I have to go. Thank you.
We understand.
Bye.
Yeah. Miss Geraldine, can you read this one for us?
Where is my this? I need to sign up.
Can a group that is formed for the sole purpose of obtaining group insurance qualify for group coverage?
No.
Yes, but only if the group is over 35 people. No, a group of individuals cannot apply for group coverage unless represented by association or trust. C, yes, any group can apply for group coverage. D, no, the group must be formed for a purpose other than obtaining group insurance.
Okay.
D. Is
the group must be formed for a purpose other than obtaining group insurance.
Okay.
D.
Okay. There we go. You want to read the explanation, Ms. Geraldine?
Yes. In order to qualify for group coverage, the group must be formed for a purpose other than obtaining group insurance. The group must be incidental to the group.
Okay.
And I remember this one by just thinking, like us foreigners, you have your associations, the different, like the Igbo group, the Cameroonian group, that exists, then the insurance comes after.
Or the Onitsha group.
Yes, we did that.
Onitsha is not a tribe.
Well, it's a group also.
It's a group.
Yeah,
I mean, people from Onitsha.
Yeah, it's a group, yeah.
Yes, we had one for those of us when this problem of looking for GoFundMe when somebody dies. In our group, we pushed them to get a group destined for those who are not covered to have insurance. So it's working.
So, so Desmond, you're from Onitsha.
Well, Onitsha is a small entity when it comes to, well, almost every village now in America has a group.
Okay.
But
Onitsha is a big city.
Onitsha is the biggest city I can say because of the market there.
That's what I was about to say. I remember Onitsha because of Onitsha market.
And the Niger Bridge closer to it.
Oh, the Niger Bridge is closer to Onitsha market.
Yeah, Onitsha, yeah. Mm-hmm.
Yes, there's a market there called Head Bridge.
Head Bridge is under the Niger Bridge.
Okay, nice. Now, how is Onitsha in Enugu?
No,
it's in Anambra.
It's in Anambra State.
In Anambra, okay. Thank you for teaching. I like to learn about Nigeria.
Mm-hmm. You know? Nigeria, yeah.
Mm-hmm. Yes. All right. So 4 of 15. Let's see. Florence, are you with us? Florence, are you with us?
I can read it. Can you hear me now? Maybe I can read.
All right, Desmond, go ahead.
I feel a lot better. Which of the following is a feature of a disability buyout plan? A short elimination period. B, a lump sum benefit payment option. C, tax deductible premium. D, taxable benefits.
Okay. So the best way to solve this question is through elimination. If you use the process of elimination, you eliminate 2. Okay, so let's start with D. Are the benefits for a disability policy taxable?
No.
All right, so we eliminate 1 there already. We'll go to C. Tax deductible premiums.
No.
All right, we eliminate C and D. So we are left now with A and B. So let's ask the question. Does elimination period have anything to do with disability buyout plan?
No.
Nope.
No.
So we eliminate A. What is left hanging?
Lump sum benefit.
Correct.
Payment.
Ask that question again concerning A. I didn't quite get it.
The question was, does the elimination period, does the disability buyout plan has anything to do with an elimination period?
No.
And the answer is no. Because a disability is something that they'll pay you lump sum when it happens. So there's there is no elimination period there.
No.
So that leaves us with B.
Wow. See, the confusion that exists there has been cleared.
I'm glad it helped, Desmond.
Oh, Mr. Valentine, you're going to come with me to the exam hall.
When are you doing it?
It's going to be a while before I can do it.
Yeah.
Yes.
I was supposed to do yesterday. I canceled it again. I rescheduled.
Desmond.
Yes, sir.
When both you and Tina pass, I'm going to make you guys a promise. When both you and Tina pass, or when one of you guys passes, if Pastor Okechukwu or Mark Ode allows me, I'll come hold a luncheon in person for you guys in Seattle.
Okay, wow. Thank you. I will love it. Do you live in Seattle, Desmond? Huh?
Sister Tina, I don't know who Desmond is. Pastor Des.
I can't even say who.
Pastor Des is Pastor Des.
Don't tell me that. my little brother. Oh my God. Oh my God. Oh, okay.
Tina,
So you don't know my full name, huh?
I know, but I wasn't thinking it's you. You see, your voice sounds so different to me.
Okay, thank
Tina,
God.
Sir?
I'm going to charge you a fee for this introduction.
Oh my goodness, my little brother, how can you not? I even know him up to the home. It's not like I knew him here.
There you go.
Yeah.
Well, that is how fun this class is. We're beginning to know each other. People we didn't even know were so connected to us. Yes. So let's submit. So when you guys pass, I'll come up there and I'll do a launching for you guys.
Amen. We'll pass
very soon.
Olua, that holds true for you also. Lincoln is just 2.5 hours from me. When you pass, again,
Great.
with the permission of Mark Ode and Pastor Okechukwu, I'll come up there and help with your launching.
Sure.
I'll be so glad to
That
have
would
you.
be very nice.
That would be wonderful.
That would be
Yeah.
good.
That's a promise.
Thank you.
Okay. So let's go to the next one. 5 or 15. Olua, you want to read this one?
Okay. Assuming that all of the following people are covered by a high deductible health plan and are not claimed as dependent on anyone's tax returns, which would not be eligible for a health savings account. Hey, Jenny is 60 and also has a long-term care insurance plan. Joe is 40 and is not covered by any other health insurance. Andy is 55 and is covered under a dental care policy. Amanda is 67 and is not covered by a basic medical expenses policy. I think Amanda, she is not covered. And she is 67.
I'm wondering, how does A look?
Jenny is 60 and also has a long-term care insurance plan. He has an insurance plan.
Yeah, this one is 67. I don't know if it's
67 and it's not covered by basic medical expenses policy.
It's covered by basic medical plan. Expenses plan.
Sorry, it's covered. Oh, sorry.
Okay. So there might be a common denominator in 3 of the answers that might suggest what the answer is. I don't know what the answer is, but there might be a common denominator in 3 of those answers.
Okay, Joe is not covered by any health.
okay.
And
Jenny is long-term care insurance.
Andy is already covered.
Under dental care policy.
And John is already covered. So there are 2 people.
That are not
and Amanda is covered. The other one that's not covered
is Joe.
C.
Joe.
B.
B, yeah, Joe. She's not covered.
So would that be B?
Okay.
Sure. Eligibility, that's what is confusing.
All right. So I might be wrong. I might be totally wrong, but let me go on a limb here.
Okay.
When I look at A, B, and C, or let me give you guys the hint to see if we will arrive at the answer. Think of when Medicare starts.
Yeah, that's why I was thinking about Amanda.
65.
67.
Okay. So there are 3 of those that are not related to Medicare and 1 that is related to Medicare.
Yes, that's Amanda.
So let's see if that is right. If it's not, if it's not the right answer, we'll learn, but let's see.
Yeah, that's what I was thinking, but I don't know if I'm thinking right.
And that's correct.
Yes.
Wow.
Yeah.
Interesting.
Yeah, that's what I was thinking, Amanda.
So I didn't know what the criteria were, but just by looking at it, there's one that is an outlier, and that is somebody who is 67. They are already covered by Medicare.
Medicare, yes.
So they're going to be less likely that they will need a health savings account.
Because they're retired already, I think. Yeah.
Correct. So, Olua, you want to read that explanation?
Sure. To be eligible for a health savings account, an individual must be covered by a high deductible health plan, HDHP, must not be covered by other health insurance except for specific injury, accident, disability, dental care, vision care, or long-term care insurance, must not be eligible for Medicare, usually age 65, can't be claimed as a dependent on someone else's tax return.
Yes.
That's true.
That's why we're here. We are here to learn those defining nuggets that can help you answer a question.
Yes.
Yes. So now question 6 here. Geraldine, you want to read this one?
Which of the following will be a qualifying event as it relates to COBRA? A, termination of employment for stealing. B, eligibility for coverage under another group plan. C, eligibility for Medicare. D, termination of employment due to downsizing. I'll go with D.
Yeah, D is the answer.
Right.
COBRA.
And remember, you see Medicare again coming in as one of the answers but that is going to help you eliminate.
Yeah.
Yes.
And we know that for COBRA, it cannot be because you were fired for fault. So if you were fired for fault, you will not qualify for COBRA. And we are correct. Jay, you want to read that explanation?
Yeah. Employees qualifying event include the termination of employment for reasons other than for misconduct. Dependents qualifying events include the death of an employee, divorce, or legal separation.
Correct. Correct. All right. Tina, you want to read this one?
Which is true regarding HMO coverage? A is divided by state. C, it is divided based on the average of bracket of a family. C, HMO provide nationwide coverage. D, it is divided into geographical area, which is D is the answer.
Okay. Just give me a quick minute. Let me answer this call. My wife is calling. So when Madam calls, you have to answer.
Yeah, you have to, yeah.
So just a minute. Yeah. Hello? Okay, well. Yeah. Let me open a door here and I will.
I took a sample of the exam and the majority of the questions come from this area.
Oh, yeah.
Yes.
I think, yeah.
Yes, they come from this area.
Yeah, I think because when you do like exam mode, most of this question is there.
Yeah. It'll be a good area to concentrate on.
Exactly. That's where I struggle too.
Yeah.
All right. So
Geographical area, territory.
all right. Let's go with that. There we go. Tina, you want to read the explanation?
HMOs offer service to those living within specific geographic boundaries that may be formed by county lines or city limits. If one lives within that boundary, they are eligible to belong to the HMO, but if they do not live within the boundaries, they are ineligible.
Okay. Let's just hope that they don't do gerrymandering and redistricting as they're doing in Texas.
How? Oh, I know.
Yes. You know, in Texas, they are doing redistricting.
That's politics.
Correct. Correct. That was just a joke, though. Yeah.
Yeah.
All right. So, Olua, you want to read this one for us?
Okay. Which of the following is considered a qualifying event under COBRA? Promotion, relocation, marriage, divorce.
D.
Divorce.
Divorce.
All right, let's go with that. That's correct. You want to read the explanation, Olua?
Okay. Okay, 1 minute, excuse me. Yeah. Other qualifying events include the voluntary termination of employment, an employee's change from full-time to part-time, or the death of the employee.
Okay. That's good. I just want to state that with the amount of specific knowledge that you guys are getting on these chapters, you are guaranteed to pass this exam.
Okay. Yeah. Okay.
I mean, with the specific knowledge that you guys are getting, diving into these health plans, understanding them, be very confident that you have the tools to go pass this exam.
Yes.
All right. 9 of 15. Ms. Geraldine, you want to read this one?
Sure. Which of the following will basic medical expenses coverage not covered? A. Surgeon's fee. B. Mental illness. C. Hospice. D. Maternity.
This one, this one is a tricky one, but I think the debate here could be between A and C.
And C, yes, A.
But I'll default to A also. So
basic expenses will not cover surgeons.
And that's correct. Yes.
Yeah, they don't cover surgery.
Yes. Miss Geraldine, you want to read the explanation?
Well, basic medical expenses coverage offers a wide range of limited benefits that typically result in high out-of-pocket costs. Basic medical expense coverage provides coverage for non-surgical services a physician provides and can be used for emergency accident benefit, maternity benefit, mental and nervous disorder, hospice care, home health care, outpatient care, and nurses' expenses.
Okay. That's good. Desmond, you want to read this one for us?
Regarding long-term care policy, which of the following would not be included in activities of a daily living? eating, A, eating, B, dressing, C, sleeping, D, breathing.
Sleeping.
Sleeping.
C, sleeping.
Right. Okay.
Normally, to be eligible for benefits from a long-term care policy, the insured must be unable to perform some of their activities of daily living, ADLs, including bathing, dressing, toileting, transferring, mobility, continence, and eating.
Okay. That's good. By the way, I'm learning also with you guys, you know.
Yeah, teacher always learns.
Yes, I'm learning and I'm loving what I'm learning. So, Tina, you want to read this one?
Which of the following is considered the presumptive disability under a disability income benefit? Loss of 2 limbs, loss of 1 eye, loss of hearing in 1 ear, loss of 1 hand or foot. A, I think A, because it's lots of 2 limbs. It's not presumptive disability.
It could be C. Presuming that you've
Loss
lost
of
one ear.
one eye, yeah, it has to be 2.
Okay.
I don't know, I just say. Okay, which one it is? Somebody coming.
Okay, I'm
I think
gonna.
A.
I can't recollect.
Because all the other B, C, and D all have 1.
1, yeah. But
Yeah.
A has 2. That's why I said presumptive.
Okay, there's something that I want us to do. Because
Okay.
I really want us to get this one right and also understand why.
Okay.
So let me Google what presumptive disability is. These days we can turn to Mr. Google.
Mr. Google, tell us, Rochelle.
All right. So they say presumptive disability refers to a situation where a condition is so severe that it's automatically presumed to be a total disability, often without needing extensive medical evidence. This can be used by programs like the VA or Social Security to expedite benefit payments to individuals with conditions like blindness, deafness, or amputation of limbs. Essentially, the severity of the condition leads to the presumption of disability, allowing for quicker access to benefits.
So it could be loss of 2 limbs then.
Yeah,
Is
A should be the answer.
That was very good, Tina.
Yeah,
Tina, when are you taking this exam?
I don't know what I messed up. I supposed to take it this Friday, but it's postponed to next Friday.
Why? Why did you say you messed up?
When I registered, I don't think they told me that I needed to do fingerprint before I took the exam.
Who said that?
And that's somebody they told me, but then I called in the morning to cancel it, to reschedule. After I said reschedule, so they told me that I will need the fingerprint only when I finish the exam. But I thought that was before exam because there are some information I got that I'm supposed to do the fingerprint.
Was it supposed to be this Friday, tomorrow?
Yeah, but now it's postponed it to next week, Friday. But it's okay. It's okay. I will have time to.
Why didn't you call me, Tina?
I call you. It was just yesterday. I was so stressed out.
Next time, call me.
Because I call them, then when I call this to PSI to reschedule, then I said, send me information because I don't understand what's going on. So she sent me information. She said, no, you don't need it. It's after you took exam. Then when you
don't
apply
need it.
for patents.
Remember, you don't need to take fingerprints to take the exams in Washington, and you don't need to have taken the readiness exam either.
Yes, that's what I learned that last night. But you know, by then I've already canceled my exam. I learned it this morning.
Okay.
By then I've already rescheduled. I said, okay. Now I feel so bad. I would have done it and get it
That's
over,
okay.
but I still okay.
So go ahead and read this explanation, Tina.
Okay. Presumptive disability is a provision that is found in most disability income policies that specifies conditions that will automatically qualify the insured for full disability benefits, such as the loss of 2 limbs. Okay. All right. That's correct.
All right. Miss Geraldine, you want to read this one?
All the following statements concerning accidental death and dismemberment coverage are correct except A. Dismemberment benefits are paid for certain disabilities that are presumed to be total and permanent. B. Accidental death and dismemberment insurance is considered to be limited coverage. C. Death benefits are paid only if the death occurs within 24 hours of an accident. D. Accidental death benefits are paid only if death results from accidental bodily injury as defined in the policy.
Okay.
So, can I answer it?
We can eliminate C.
No, I think so.
Except.
Except.
Oh.
Okay, yeah, you are right. Okay. Yeah.
No.
No, we are not eliminating it. That's the answer, actually.
Correct. That's actually the answer.
Yes.
Because Desmond, remember they said except.
Oh, well, you see where the confusion comes now.
I know. Correct. It happened to me all the time, but today I pay attention.
And remember that for an accident to happen and for the death to be considered as having resulted from the accident,
okay,
it has to
if
be,
the person
I think,
dies
within 90 days.
90 days, yeah.
Yes. So within 90 days, if you're in the hospital and you still die, you're considered to have died from the accident. So the answer, I think, is C.
Yeah.
There we go. Ms. Geraldine, you want to read the explanation?
Yes. Under an accidental death and dismemberment insurance policy, the death benefit will be paid if the accidental death occurred within 90 days of the accident, not 24 hours.
Very true. So we learned some 90 days. Remember, 90 days.
Yeah.
All right. Desmond, you want to read, Pastor Desmond, you want to read this one?
Now you're rubbing it in here now.
I
know. I have to give you your full credit. You're a pastor. I cannot just be calling you Desmond. It has to be Pastor
Desmond.
And
I've been calling him Desmond. You see?
You're a man of the cloth. I have to give you respect.
I know.
I am actually Pastor Dr. Desmond.
But
with as a student, I don't have to be a doctor anymore.
Yeah,
there you go.
A policy available to business owners that provides payment for normal business expenses in the event that the owner is disabled is called A, partial disability, B, credit accident and health coverage, C, business overhead expense. D, current disability. A policy available to business owner that provides payment for normal business expenses in the event that the owner is disabled is called.
I'll say C.
Business overhead.
I'll say C.
C.
C, business overhead expense.
Correct.
Yes.
Hang on, what do we call that policy? Key owners policy, right?
Okay, we have this. We have,
Key
okay, let me, Desmond, good question. Let me explain the three policies we are talking about here and explain the delineations, right?
Okay.
We have key person policy.
Policy, right?
We have a key person policy. A key person policy will be for the death of a key person that is selected by the company.
Okay.
And the purpose of that is to use that money to help the business continue if that key person dies.
Dies, yes.
That is key person. There is key person disability insurance.
Okay.
Which again is for a key person, but if that key person becomes disabled, the business will use that policy to pay, again, to help the company cope with the disability of that person. Okay. Then there's a third, business overhead
expense policy.
Expense policy, which again will be used to cover business or business overhead disability policy, which again will be used to cover business overhead expenses if that employee becomes disabled. And those overhead expenses include things like rent, pay for electricity, maybe pay for the running of a car. All of those are overhead expenses. And the question says, policy available to business owners that provides payment for normal business expenses.
Okay. Okay. I
Normal
didn't highlight
expenses
that.
in the event that the owner is disabled.
Yes, that gives it, that clarifies it.
Correct.
Read within the line.
Yes, so business overhead expenses. You and Tina, you can have the ability to take over Seattle when you guys pass this exam.
We will take the whole
Amen.
Washington
We will do
State.
that.
Amen.
Take over the whole Washington next.
Washington State.
I'm flying over there and I'm helping you people conquer.
Oh,
Yes.
God.
All right.
Yes.
Amen.
So, Pastor Desmond, you want to read this?
Okay. Business overhead insurance is often purchased by small employers to pay the ongoing business expenses, such as payroll, in the event that the owner of the business becomes disabled. Premiums paid are tax deductible as a business expense, but proceeds paid are taxable as income.
All right.
Okay.
That is good. That is good. Let's go. We have two more to go. Olua, you want to read this one?
Okay. Most health TC plans have which of the following features? Open enrollment, no elimination period, variable premiums, guaranteed renewability.
And Olua, what does LTC stand for?
I don't know. I can't remember.
Long-term care.
Long-term care.
Okay, yeah, that's true.
LTC equals long-term care. I know you're new. I knew you're just starting to read this, so I just wanted to make sure you understand that.
I've not started reading at all. I just joined to.
Have you started? Have you secured your study materials?
Not yet.
Okay. I have to talk with Pastor Cordelia to make sure that you secure those materials and you start reading, because you have the potential to go pass this exam fast.
You know?
Yeah.
Thank you.
So, yeah. So, which is the answer here?
D, guaranteed renewability.
Correct. Correct.
Yeah. That's true.
Guaranteed renewability.
Yeah.
Okay. You want to read that, Olua?
Yes. The benefit amount payable under most long-term care policies is usually a specific amount per day, and some policies pay the actual charge in care per day. Most long-term care policies are also guaranteed renewable.
Okay.
However, insurers do have the right to increase the premiums. Yes.
Okay. And remember, they have the right to increase premiums. You'll see this in the exam. You see this in the exam. They are guaranteed renewable, and the insurance companies have the right to increase premium.
Yes.
Let's go to the next one. Let's have Geraldine conclude this.
The HMO Act of 1973 required employees to offer an HMO plan as an alternative to regular health plans if the company had more than 25 employees. How has this plan since changed? A, employers are no longer forced to offer HMO plans. B, the minimum number of employees has decreased. C, the minimum number of employees has increased. D, the source of funding has changed. I'll go with A.
Yes.
Okay.
Yes, A is the answer.
Because the number of HMOs have dropped over the years.
No, they don't want to.
They're not forced to do that no more.
Yes, that's very good, Geraldine. You are in the healthcare sector and you nailed it. So that's good. Well, let's submit and see what our score is. 100%.
Round up.
So I am very excited. Next on Sunday, I'll try to see if we can handle like 3 chapters.
Yes, please.
You know, because I know a lot of you guys are primed to go take this exam within the next 1 to 2 weeks. So let me go and see which chapters we're handling on Sunday. Let's take a look. Health policy provisions, clauses and riders, social insurance, and probably other health insurance concepts. So we'll probably try to handle all of these 3 on Sunday.
Okay.
So I'm very excited, and I'm very encouraged by what we are learning. Not just you guys, but myself too, you know. And with all of this, remember, with all of this knowledge that we are learning, that means as you guys recruit people and bring them, we'll polish them very well and they'll go pass this exam easily, you know. So I'm very committed to growing this team. I don't care if you are being recruited by Maes, by Carolina, by Pastor Okechukwu, whoever. Drop them in class. We will help you guys go pass this exam so that we can help our people out there. Okay? Yeah.
Thank you.
And
What
remember,
is the other one that we're supposed to do? Number 7, what's the name again?
Number 7, let's see.
Can you, chapter 7, what is it?
We'll
Can you pull down again? Let me see.
Health policy provisions, clauses and riders.
And riders.
In fact, let me take a picture so that I know which ones.
I have a question for you.
Go ahead.
Are you not giving us the recorded part of this anymore? Because we've promised several times, but I'm not receiving anything. I don't know why.
Me too. I haven't gotten any.
All right, Florence. Again, I'm not going to apologize because the last time I apologized.
No more apologies.
No more apologies. All right, Florence. When a man has failed, he just has to accept that he's failed. It's just I'm gonna work with Dr. Omotola, who is very savvy in this. To put all I need to do is load this to my YouTube account and share the link. I will work hard to make sure that that gets done because the fact that you're asking means.
Before we take this exam, I want it to be sent, please.
All right. I will do that. I will do
It's
that.
already registered. Okay.
Yes, I will do
You
that.
registered.
And Florence, you are in Arlington, right?
Yes.
And I was just in Arlington on Sunday. I should have called.
Arlington, Texas.
Yes.
Oh.
Arlington is a suburb of Dallas.
Dallas, I know. Yes, yeah.
Yes. So I will promise to get this done within the next few days, you know. Yes.
All right.
It means a lot and you need to have it. So I will work on it. Yeah. All right. You guys have a good one. And let's look forward to Sunday to cover about 3 chapters. You know, we'll cover 3 chapters on Sunday, and then some on Monday, maybe some on Wednesday, so that you guys can go pass this exam. Okay.
All right. Thank you.